Markets are on high alert, with the VIX at 19.2, as we await the GDP Advance Estimate this week, which could propel cyclicals, technology, and financials. Stay with me, your complete market intelligence briefing starts right now. The market tone remains generally optimistic, with the S&P 500 rising by nearly 1% week over week, while the NASDAQ posted an even more impressive gain of 1.77%, as the market continues to absorb the latest economic data. The VIX, a measure of market volatility, has declined by 1.74%, signaling a relatively calm market environment, with the current level of 19.16 indicating that normal conditions are prevailing. This week, all eyes will be on a series of key economic releases, including the GDP Advance Estimate, PCE Inflation Data, and non-farm payrolls, which could potentially shift market sentiment. The top performing sectors, including commodities, energy, and technology, are likely to remain in focus, driven by factors such as rising oil prices, which have surged by 9.13%, and the ongoing strength in the tech sector, which has gained 2.32%. On the other hand, lagging sectors like real estate, financials, and healthcare may face challenges, with the healthcare sector, in particular, declining by 3.1%. The overarching theme for this week is the delicate balance between economic growth and inflationary pressures, which will be closely watched by investors and policymakers alike, particularly in light of the upcoming FOMC rate decision. As we navigate this complex market landscape, it is essential to stay informed and adaptable, always keeping in mind that this is educational content and not financial advice. Now let us go sector by sector and break down exactly where the opportunities and risks lie. Technology sector performance was robust this week, with the sector ETF gaining 2.32% and an impressive 12.94% for the month, indicating a strong bullish trend. However, the signal is neutral. The key drivers of this performance were the semiconductor and software segments, with notable names such as Nvidia and Microsoft leading the charge. Apple and Google also contributed to the sector's gains. This week, the key risk or catalyst to watch is the FOMC rate decision, which may impact the sector's momentum. With an RSI reading of 72, the sector is approaching overbought territory, suggesting some caution. In this context, strategic positioning should focus on a balanced approach, considering the potential for a pullback, while maintaining a long-term bullish outlook. Please remember this is educational content and not financial advice. Healthcare sector performance was lackluster this week, with the sector ETF declining by 3.1% and 1.41% for the month, indicating a bearish trend. The Relative Strength Index, or RSI, reading of 46 suggests the sector is not oversold, but rather in a neutral territory, which could lead to further downside. Key names such as Johnson & Johnson, United Health Group, Pfizer, AbbVie, and Merck are worth watching, as they tend to influence the overall sector direction. This week, general market conditions will likely continue to drive the sector's performance, and a key risk is a broader market decline. From a technical perspective, the RSI reading suggests the sector may be due for a bounce, but the overall trend remains bearish. As such, a strategic positioning approach would be to maintain a cautious stance, and this is educational content, not financial advice. Financial sector performance was lackluster this week, declining by approximately 1.93%, despite being up 4.22% for the month. The sector's trend has turned bearish, with a bearish signal, driven primarily by concerns over interest rates and inflation. Names such as JP Morgan, BASE, and GS are worth watching, given their significant influence on the sector. The key risk this week is the FOMC rate decision, which could further impact the sector's trajectory. With an RSI reading of 62, the sector is approaching overbought territory, suggesting a potential pullback. Strategically, it may be prudent to exercise caution, as the sector's performance is heavily tied to economic conditions, and this week's economic events, including the GDP Advance Estimate and PCE Inflation Data, will be closely watched. Please remember this is educational content and not financial advice. Energy sector performance was notable this week, with the sector ETF gaining 3.36%, despite being down 6.11% for the month. The Relative Strength Index, or RSI, is at 38, indicating a bullish trend in signal. This week's move was likely driven by anticipation of the GDP Advance Estimate for Q1 2026, which may impact energy demand. Names like ExxonMobil, Chevron, and Schlumberg are worth watching, given their significant weight in the sector. The key risk or catalyst this week is the potential impact of the GDP estimate on energy prices. From a technical perspective, the RSI reading suggests the sector may be due for a rebound. Strategically, investors may consider positioning themselves for a potential upside, keeping in mind this is educational content and not financial advice. As market dynamics can shift rapidly, it is essential to stay informed and adapt accordingly. Consumer sector performance was lackluster this week, declining by 1.43%, despite a respectable 7.19% gain this month. The sector's trend and signal are bearish, indicating potential downward pressure. Key stocks such as AMZN, TSLA, and Nike are worth watching, given their significant influence on the sector. The sector's decline was driven by concerns over consumer spending, which may be impacted by the upcoming GDP Advance Estimate Q1 2026 and PCE Inflation Data. With an RSI reading of 63, the sector is approaching overbought territory, suggesting a potential pullback. This week, the key risk or catalyst will be the non-farm payrolls report, which may influence consumer confidence and spending. As a strategic positioning comment, investors should be cautious and consider a more defensive approach, keeping in mind that this is educational content and not financial advice. Industrial sector performance was lackluster this week, declining by 0.6%, despite a respectable gain of 4.46% for the month. The Relative Strength Index, or RSI, currently stands at 59, which suggests a bearish trend, further reinforced by a bearish signal. Key names such as Caterpillar, Honeywell, and Boeing are worth watching, given their significant influence on the sector. This week, the GDP Advance Estimate for Q1 2026 and non-farm payrolls will be critical economic events affecting the sector. From a technical standpoint, the RSI reading indicates the sector is not overly extended, but rather is experiencing a pullback. As a result, investors may consider a cautious approach, keeping in mind that this is educational content and not financial advice, and should carefully evaluate their strategic positioning in the industrial sector. Materials sector has shown a modest gain of 0.08% this week and 5.08% this month, indicating a relatively stable performance. The sector's neutral trend and signal suggest that investors are waiting for a catalyst to drive the next move. Companies like LIN, SHW, and FCX are worth watching, given their significant influence on the sector. The GDP Advance Estimate Q1 2026 is a key economic event that may impact the sector, as it will provide insight into the overall economic growth. With an RSI of 68, the sector is approaching overbought territory, which may lead to a pullback. Strategically, investors may consider positioning themselves for a potential correction, keeping in mind that this is educational content and not financial advice. It is essential to evaluate your own risk tolerance before making any decisions. Utilities, a sector that has been exhibiting neutral trend and signal characteristics, saw its corresponding ETF, XLU, post a modest gain of 0.04% for the week, bringing its monthly return to 2.06%. The Relative Strength Index, or RSI, is currently reading at 57, which is generally considered neutral territory. This week, key names such as NA, DUK, and so are worth watching, given their significant weight in the sector. The upcoming FOMC rate decision is a key risk or catalyst that could potentially impact this sector, as changes in interest rates can influence the attractiveness of utility stocks. From a technical perspective, the neutral RSI reading suggests that the sector is not currently overbought or oversold, which may indicate a period of consolidation. As such, investors may want to consider a strategic positioning approach that emphasizes stability and dividend yield, keeping in mind that this is educational content and not financial advice. Real estate sector performance was driven by a combination of factors, including economic events and market expectations, resulting in a decline of 1.43% for the week, despite being up 8.49% for the month. Names such as PLD, AMT, and EQIX are worth watching, as they have been impacted by the sector trends. The key risk this week is the upcoming PCE Inflation Data, which may influence the FOMC rate decision, affecting the sector's trajectory. The technical reading based on the RSI, which is at 72, indicates a bearish trend, suggesting potential overbought conditions. Strategically, investors should be cautious, considering the sector's valuation and potential interest rate implications, remembering that this is educational content and not financial advice, as we navigate normal market conditions. Crypto sector performance was relatively stable this week, with the sector ETF IBIT gaining a modest 0.18% and a more notable 9.58% for the month. The Relative Strength Index, or RSI, is at 62, indicating a neutral trend, and our signal is also neutral. Key names in this sector, such as Bitcoin, Ethereum, Solana, Coinbase, and MicroStrategy, are worth watching, as they have been driving the sector's overall performance. The main catalyst this week is likely to be general market conditions, which will influence investor sentiment. With the RSI at 62, we are not seeing overbought conditions, which is a positive sign. Strategically, investors may consider positioning themselves for potential upside, given the sector's relatively stable performance, but please remember, this is educational content and not financial advice. Commodities sector performance has been notable this week, with the sector ETF GSG posting a gain of 7.35% and 7.1% for the month, driven by a combination of factors including general market conditions and a surge in key names such as gold and oil. Names worth watching in this space include GLD, SLV, and USO, which have been leading the charge in the sector. A key risk or catalyst to watch this week is the overall market sentiment, which can impact commodity prices. From a technical standpoint, the RSI reading of 58 suggests the sector is in a bullish trend, but not yet overbought. Strategically, investors may want to consider positioning themselves to take advantage of potential further gains in the sector, keeping in mind that this is educational content and not financial advice. Forex sector performance was modest this week, with the UUP ETF gaining 0.44%, although it remains down 0.79% for the month. A neutral trend is evident. The recent move was driven by expectations of the upcoming FOMC rate decision, which will likely influence key currency pairs such as euro to US dollar, pound sterling to US dollar, and US dollar to Japanese yen. Names like DXY are also worth watching, given their close correlation with the US dollar. The RSI reading of 43 suggests the sector is not overbought or oversold, indicating a neutral signal. This week, the FOMC rate decision poses a key risk, or catalyst, that could significantly impact the sector. In this context, it is essential for investors to maintain a strategic positioning, considering the potential for increased volatility, and remember this analysis is for educational purposes only, and not financial advice. This week is packed with high-impact economic events that will significantly influence market dynamics, and it is essential to understand the implications of each release. Starting with the GDP Advance Estimate for Q1 2026, this report is the broadest measure of economic growth, encompassing consumer spending, business investment, and government outlays. The market consensus expects a moderate expansion, around 2.5% growth, which would likely boost cyclicals and support risk-on sentiment. A beat would further reinforce this trend, potentially leading to a rotation into value and away from defensives, whereas a miss could fuel a defensive rotation, favoring staples, utilities, and healthcare. The PCE Inflation Data, scheduled for release, is the Federal Reserve's preferred inflation measure, directly influencing rate path decisions at the next FOMC meeting. The market expects a reading of around 2%, which is in line with the Fed's target. A higher-than-expected reading could lead to a hawkish tone, bolstering the dollar and causing a sell-off in bonds, while a lower reading could prompt a dovish reassessment, potentially boosting equities. Historically, PCE releases have been associated with moderate volatility, particularly in the rates market. The non-farm payrolls report, the most market-moving monthly jobs report, will also be closely watched. A strong jobs number could lead to a hawkish interpretation, pressuring bonds and supporting the dollar, while a weak jobs number could lead to rate cut pricing, boosting equities and other risk assets. The sectors most exposed to these releases include technology, financials, and consumer discretionary, which are heavily influenced by economic growth, inflation, and interest rates. Please remember, this is educational content and not financial advice. It is essential to assess your own risk tolerance and investment goals before making any investment decisions. Thank you for watching Financial Market Oracle. Please like and subscribe. Comment on the sector you are watching this week. Remember, this is educational content and not financial advice. Have a profitable and disciplined week. I will see you next week. Stay profitable. This video is for educational and entertainment purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. Past performance is not indicative of future results.